All right, we got a really good bullish signal today on the market forecast chart. So I'm going to show you what that signal is, what it means. When was the last time we've seen signals like this? We have multiple instances here. One more recently, one towards the end of last year. Very similar. Very similar pattern on other indicators too. So that will kind of give us an idea of what kind of bullish bounce we may have if we get the bounce. The other thing too is the probabilities that we won't get the bounce. How likely is it that we won't bounce off of this and that we'll continue with what we saw today? Was today just a one-off, or are we going to go into next week? There are some signs of bearishness heading into next week. So I'm going to show you what those are, and how bullish we actually have been. I'm going to give you my take on where I think we may be headed going into Labor Day weekend and eventually into the end of the year, and for that matter, eventually in the next year. That's how important this week is. It gives us an idea, and next week and the week after, like this period right now here, last week, this week, next week, will really be. It's not just, will not just tell us what to expect going into September. It will tell us what to expect going into the end of the year. It will tell us what to expect going into the end of next year. So, I mean, this has got long-term ramifications. I'm going to break all that down. And then our trade idea of the day is a trade that will take advantage of a bullish bounce. And we'll talk about how to hedge, using it as a hedge against the trade we already have on. So let's go ahead and get started. Today is Friday, August the 19th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get started, I invite you to subscribe to our YouTube channel. Click that thumbs up down there, like our video today. Comment on anything that stands out to you. Join our website at MarketScholars.com using that link up there in the top right corner of your screen. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. All right, if you're watching on our blog, as you check out some of these things over here on the right, come down to the bottom, click that heart. It opens up this tab. Hit that like button. Also, same thing with that thumbs up icon. Click on that. It opens up this tab. Hit that like button. Again, the more you do that, it really helps us get our content out to all of our followers on those social media platforms. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, obviously we had a little bit of a down day today and closing below the low of the high day and all that, and a little bit of a near-term reversal that's brought the near-term line into bearish territory. The near-term line was in bearish territory yesterday, so this is not new, but so now we're in bearish territory again, this time with an oversold momentum line. So technically, by definition, this is a really bullish pattern here. Again, kind of similar to last time we had it right there. I mean, this was the last time we had that pattern. We had strong bullish posture, a bearish near-term line that's not in oversold territory, and then an oversold momentum line. That's a bullish pattern, and that led to a nice little near-term rally that lasted 1, 2, 3, 4, 5, 6, 7 days, 6 days or so, and then now we're back down with the same pattern again. Long-term market sentiment's rising, not quite above 50 yet, but it's not in bearish territory anymore. And you still have an intermediate line that has not only in the upper reversal zone, but it's actually still above the 90th percentile. So, I mean, this is about as strong of a bullish posture as you could possibly get, considering that we're still 4% up above. I mean, to kind of give you an idea of how rare it is to stay this far up above the 30-day moving average. So I'm going to go 4% here. So this is, all the times that we've been, like, we just were this long above the 4%. We weren't above 4% for very long there. We weren't above 4% for very long there when we came back down. And you can kind of see we were above it there for a while before coming back down. And then you can see some of these other instances. Really it took, coming off of a major low point to be above 4% for about as long as we have been right now. So again, another sign you can see we never did get over here, again coming off a major correction low point to be above 4%, above 30-day moving average for as long as we were. So needless to say, we were above 4% for a good chunk of time here, pretty much for a month, right? Because the end of August, end of September, for about 3 weeks, we've been above 4% above 30-day moving average. A very strong bullish posture. So that's why the intermediate line is still above 90th percentile. And again, about as bullish of a pattern as you can get. So we have, a lot of potential to start off next week with about as bullish of a bounce as you can get, and that would be a very, very good signal, because again, it's this gap right here that we're concerned with holding, and we've already, if you already see, and I'll come back to this here a little bit later, we've already filled in, or at least started to fill in this gap. We actually never did come in and fill in that gap. Became really close. But this is the gap that's important that holds as a breakaway gap. That's the narrative shifting gap. That was a day. Again, you had some good earnings here on that Wednesday. But then once the FOMC minutes came out, we were able to hold, the CPI report came out, excuse me. We were able to hold those gains all throughout the day. So you had good earnings, you had CPI, and the narrative shifted to peak inflation, softening commodities, falling yields, and the shift. That hasn't been the case the last 3 days, but so far the gap that narrative shift created has held as a breakaway gap, and that's bullish. And so if we're able to bounce off this tomorrow, and again fill in this gap, or excuse me, Monday, and fill in that gap going into next week, then again you can see how bullish that would be, right? That would be a very, very good sign. We would maintain our position above that gap. We still haven't filled in that gap, and that's, you wonder, maybe we might gap down tomorrow or Monday and then go up, because you still got to fill that in. That's still a common gap there. But that one's below the 23% retracement level. There's multiple lines in this area. The 50% member of the long term is right around, pretty much right where we're at right now. In fact, if you look at on this chart, we came down right to that 50%, that big famous 50% mark that everybody's been talking about, that we've crossed up above, and we came right back down to it. So that would hold, and we'd be back above the 62% retracement, which is this intermediate resistance that we'd be breaking back up above, and then again holding this 23% line that you saw on the other chart. That's the post-COVID rally, right? We had retraced below it, and now we're back up above it. So if this bullish pattern plays out on Monday, it's going to be a really, really good thing for the broader markets. And obviously, you would expect that to be the case, right? You would be considering the posture and rising market sentiment. The odds are that we will bounce higher off that signal. And then we don't have to stay 4% above the moving average. The moving average is going to start kicking in. But as long as we're above it, right? As long as we don't, and if we do go below it, we don't go far below it, further than that 2.5% mark that you see down there at the bottom. So that's the S&P. If you look at the NASDAQ 100, you see the same pattern. Again, oversold momentum line that's not too extreme, oversold or bearish near-term line that's not oversold, and then a strong bullish posture. Good bullish pattern. We saw that again over here, same day, August the 9th, and we gapped up. In fact, that's the gap. That's the day we got the gap. We created the narrative shifting CPI gap. Same thing here on the Russell 2000. Russell 2000, you notice, is after breaking above these three really important lines, the 23% retracement of the post-bear market low point rally that we've had since 2009, so very long-term retracement line there that, so you can see, held multiple times. Then this retracement, 38% retracement of this of the current drop that we've been on, this long-term drop we've been on, that's brought the market sentiment line down, and then the 62% retracement of this current intermediate drop that we've been on, coming off of that cluster. So needless to say, like, that's a really, really important level, right around 1950 plus or minus a few points. And as of right now, we've pulled back down to it and produced a really good bullish pattern. So you see how the odds are kind of in our favor for a good little bounce to the upside and holding that August 10th gap. And if you look at, let's go back to the S&P 500 on the weekly, since the week is over now. Again, we talked last Friday about this really important bear tag that in the past has either produced bullish trends, right, up to new highs, or it start bear markets, right? I mean, it is a really important signal on a long-term basis. You know, it either turns this into a correction and only a correction, or it turns it into a correction that ultimately leads to a bear market, like we saw in 2008, 2001. So, which are the last two real bear markets that we've had. And you have to go all the way back to the early 80s and 70s before that. You might, I think there's one, if I were to go back to the 1990, early 90s, we might have had one too. So those are our last two real bear markets. You can see here in 87, not really a bear market. The early 90s sometimes has been considered a bear market, but you can see, I mean, not very much of one. We just came right back off. So really, the last real bear market before, this 2000 was this one in 1980, 81. And you can see we kind of got that signal right there in 81. We didn't quite get the bear tag because the intermediate line was at 50.82, and so you're dark green shading instead of light green shading. You have the yellow line, so that ended up, that's kind of the idea behind the bear tag, and you can see it produced the very, very weak bear market coming off of that. So, and then of course in 1973, 74, there's your bear tag that led to the bear market, and then in the late 70s, there's your bear tag that led to a bear market. So it's the same thing here. It's the bear tag. And again, getting above the above 2.5%. Let me get rid of that 4% mark. Getting above 2.5% above the moving average is an important distinction to avoid bearishness, right? Well, the near-term line on that bear tag was about as high as you can be. I mean, it's really, really darn high. Again, going out to like 2008, when we got that bear tag, the near-term line was up above. Let's see, it got to the 94.65, 94.66, and then see we got over here to 96.7. So kind of in that mid 90s, and then going back to 2001 on this bear tag, you can see the near-term line. By the time we got the bear tag, the near-term line was down to 75. But before that, we were up to 96.7. So you can see when we get these bear tags, we're pretty darn bullish. The last time we got one, we didn't get one with COVID because we were already dark green. We didn't get one in 2019 because we were already dark green by the time we got to the 30-week moving average. So the last one that we got was right there, and the near-term line also got into the high 90s. So, I mean, that's what it does. It gets to this high 90s on a weekly basis. The intermediate line's rising. It's still not above its market sentiment line yet. We'd like to get that thing to cross up above to really confirm the bullishness. And like I said, cross up above the 2.5% mark. So last week we talked about how we might need a week or two, especially considering this week, very, very low range week, 100 points. The week before was 168 points. So very summer. And a lot of this 100-point range was expanded out today. So it's kind of a typical end of summer type week that we might still get next week. But you can see what we really need to see. We need to see this, break back up and really hold this breakout above these important Fibonacci lines and get above that 30-week moving average by a significant amount, so that we can, avoid what we saw in, when these have started real bear markets. So that's the Russell. That's the S&P. Again, looking at the Russell, again, you see how bullish that we got. We got 5.5% up above, but remember the Russell had a little bit higher beta. We got to the 99th percentile on that the week after the bear tag. We got to the 99 on this strong move, and again, you can see the pullback to the downside. And then finally, your NASDAQ 100. You can see what it's doing. So that near-term line is still in very bullish territory. Almost back below the moving average there on the NASDAQ. But almost back in the, so the question now is whether this momentum line, which is kind of down for all the indexes, down more on the NASDAQ than on the S&P. It's not quite in oversold territory, but it's in bearish territory. So now the question is whether it will bounce back up, because you notice it doesn't stay in bearish territory. Like when you're bullish, it doesn't stay in bearish territory for long. You bounce right back up. Even when you're way down low, you bounce right back up. When you're bullish, right? When you're not bullish, then it can stay down for a while. So the question now is it going to stay down here, or is it going to bounce back up out of here next week to avoid that near-term line from having a temporary seat? See, when you're bullish, the near-term line should stay up in bullish territory for quite a while, for weeks at a time. So really important week next week to see whether or not what this week ended up looking like. From a Hakinyashi candle, we did not close above the prior week's high point. We did last week. We did not this week, but we didn't this week either, and that doesn't necessarily mean anything. The problem is when you get a lower close, right? When you start to get a transition candle and a lower close, you can see it over here. You can see it right here. And so next, like right now, the candle is going to open at 41.95, the midpoint of this bar. That's where the open will be on the Hakunashi candle, right around 4,200. We're trading at 42.28, and the close is 42.60. So like as of right now, on Monday, it would be a lower close. So if we end up with a really tight range next week or a bearish week, as you look at these 2 weeks, April 4th and January 3rd, if you look at those 2 weeks, April 4th was a bearish week, and January 3rd was also a bearish week, coming off of low range weeks prior, right? So you got the lower closes on the weekly chart on relatively bearish weeks. So if we get kind of this week, next week too, then you can see that we're going to be very susceptible to a lower close, and then of course that's been trend changing. And right now, we just do not want anything that appears trend changing back to the downside, considering the potential for a fake out, considering how strong the bullish signals have been and how bullish a lot of people have been and how bullish the narrative has been this past week and a half. That would reverse all of that, and that would be more bearish than if resistance had just held in the first place at those Fibonacci lines that we talked about. Let's take a look at the 3 green arrow charts. So we do have a red arrow on everything but the Dow. So the Dow is still dark green shading, but we have the red arrow now on the Russell. We have the red arrow now on the S&P. So again, like we bounce off of red arrows or we don't. So here's a chance for us to bounce. I mean, we got the bullish signal on the market forecast. We got the red arrow. We don't have to be on 3 red arrows, but we got the red arrow. And you'll see later today I've got a trade where we have 3 red arrows that we can bounce off of too. So, we either bounce off of this or we don't, and then we pull back to the moving average, and then you'll get 3 red arrows, and we'll either bounce off of that or we don't, and we get pink shading. But as of right now, the issue is we just do not have green shading anymore. And when you look at the stock relative to the MACD and stochastics, the MACD is below its moving average, so the red arrow, hence the red arrow, but we're still easily above the 17-day. So we haven't started like a divergent. We're still in convergence mode. So if we do bounce up, don't expect a big bounce. I mean, we'll still be in convergence mode. The MACD is still high here. And when it's high like this, it's hard to keep going up, right? Because you've already peaked on the MACD, on the histogram. So you'll just get like little tiny moves, like, where we just don't go. Like here, you got it bounce off. And you notice we just barely went up to higher highs. I mean, it's just a slow grind because the MACD was already in convergence mode. We're in convergence mode here. So if we do bounce up on Monday, it won't be a big bounce until we get more of a decline that allows us for more of a bounce up to the upside. See, even this one over here, this is that last time we got that signal, right? This one right here. And you notice we were in convergence. We were kind of starting a convergence mode there. But then we had this big push, a breakaway gap, and narrative changing push above some really important Fibonacci lines. So we can get that here and maybe push above the 200 and this 62 at 435, get above that, those layers of, but then you have the point of control above that. You have the 78% retracement. These 78s aren't so strong, but you'll have the point of control and you still have a big chunk of volume up here. In fact, the biggest chunk of volume is still above us. So, I mean, we've rallied through an area of very low volume. Like when we started this rally, things really went up here. So this would be on July the 19th. If I were to go back over here to July the 19th and then go back to July 20th of the prior year, just to kind of give you an idea of what the volume profile looked like. So we're up here now, right? We're at 819. This is where my cursor is at. This is where we're at right now, right here. This is where we're at right now, 819, and we're right about this 42, whatever this, 44 to 22, 14. Almost exactly where my cursor is. So you can see the rally filled in an area of very low volume from 719 on. That's why we rallied so much. I showed in my technical analysis class, how to view this as a short, like, what signs we see that this was a short covering rally. See, on this day, on 7/19, we broke above the 50-day moving average, barely, but we broke above the 23% retracement on both the green and the orange lines, both. And we broke above the 17 and the 30 and the 50. Broke above multiple moving averages, multiple Fibonacci lines, and really the red one too, all at the same time, right? Well, who didn't do that is Bitcoin. Bitcoin did not break above its orange or green 23% lines or its 50-day moving average, right? Let's go back to the 1-year chart. So this was back on 7/19, right? Really, really bullish. So according to where we are right now, this, right where my cursor is, this is where Bitcoin should have been, right there. That's where Bitcoin should be at 37,161. That's based off what the stock market did, right? If this was full-on risk appetite move, then this, which is along the far end of the risk appetite scale, should have also really benefited, even probably more, because it's a bigger reflection of risk appetite. So that's about where it should be, comparative where the S&P is. But if you look up at the top here, it's at 21,180. So this is where it should be, right here. In fact, if I draw my line, this is 7/19 up to 30, up to that line. That's where it should be. That's where it should be. This is where it's at, 21,180. Roughly in here. That's where it's at, right? So Bitcoin did not participate in the same risk appetite move that the S&P 500 did. If you look at ARK Investments, this is on 7/19, right? So we broke above these moving averages, got above his point of control. So same move, you'd have gotten up into this area right here. So the 100% retracement, the 38% right there, we'd have been above the 200-day moving average. So right into this area, if we had the equivalent move on ARK that we've had on the S&P 500, that's where ARK would have gotten to. Instead, ARK is at 44.69, which is right here. That's where ARK Investment is. Okay, so you see SPX is up to 42.28. 42.28 right there. That's where SPX is. So SPX did make that run that ARK and Bitcoin have not. And in fact, not only did they not make that run, they're not very, I mean, they're pretty darn close to where they were on July 19th when this whole thing, when this quote-unquote risk appetite move started. So it wasn't really a risk appetite move, it was a short covering move. And it's very well documented, right? And we saw even today a lot of that gamma coming off from people buying call options and such. So it was very much a short covering move that, you wonder if it's waning. You can see, I mean, it was a really strong, to the point of being a short covering move that produced a lot of really strong bullish signals. I mean, you're above 35, you well above 30, almost got to 40. The ADX is above 30. So you got a very strong pattern that's still strong, even with the little pullback we're getting. You get the RSI and the CCI, we got above 70. I mean, these are all signals. I mean, now we're kind of back to maybe neutral territory, and this one is, CCI is, but still, I mean, they're not bearish, so they're just kind of breathing a little bit. When you look at the trend strength indicator, it's still very strong trend, still above 5, still above 80. You're still above the green line, so that, I mean, this is hardly a death-defying drop here, and you're easily above the cloud. Remember, we got to stay above this cloud by the time it turns green. It turns green here at the beginning of the month of September. So as long as we can make it to Labor Day without it falling down in here, we have a really good chance of this maintaining a bullish trend, right, and staying above that green line. That's SPY. When you look at Bitcoin, Bitcoin's not above that, and when you look at ARK Investments, it's also a lot closer to being back below the cloud by the time we get to green, right? So that's the concern, right? QQQ, you can see again, it turns green right about the same time, right about Labor Day. So as long as we can maintain, not only as a breakout, but maintain being above the cloud, we have a good shot at this, right? We have a good shot at staying bullish here. When you look at the, I wanted to look at the Hull moving average, and you can see, okay, we broke down below. The 20-day Hull has turned red on the Qs. It has not turned red on SPY. It has not turned red on IWM, though the parabolic SAR has flipped, and we have dropped below the MACD over here, down here, the 9-day average on, the purple line is how far away we are from the 200-day Hull, which is very, very high. So we have broken down below that line. And the other thing too is we've broken down below, is it this one? No. Yes, it is, but I've got it over here. We've broken down below the moving average, right? The moving average, and we've broken back below 80. Now over here, again, we talked about a very similar pattern to what we're getting now, and we bounced up and maintained, right? Maintained the convergence, in this case going into expiration. Right now, unfortunately, we're coming out of expiration, so you kind of worry about, how much of this bullishness going into expiration is going to wane. I mean, it ended up being one of the biggest, if I were to go all time here, go to options expiration. Yeah, sorry, go back to all time and then options expiration. This ended up being one of the biggest. Now we fell from where we were at 11.23. So we ended up only getting down to 9.45651. Right, that's where we ended up getting to. It still, as you can see, is one of the bigger options expiration cycles that we've had. I mean, top 10 of the last so many decades. So it was a really, really big move. Unfortunately, these big ones tend to come off of really bearish ones, and they're hard to sustain the next time. Off of 2019, we were able to do it, but all these others, we really were hard to sustain the bullishness going in. This is the bear market low point where we had multiple options expiration cycles. That was a bear market rally. These were bear market rallies in 2001 and 2002. And you can see another one over here in October 99. It's hard to sustain the really good run, especially when you have a volatility extremely low, right? And volatility is expected to gap up. It's down here at 20. I talked about the correlation between the VIX and VIX 3M. I don't think I didn't save it. Okay, let me remove this and bring up that correlation again. So let's pull up VVIX. I'm going to save it this time. Okay, I talked about this abnormal. How about I actually get VVIX in here? The volatility of the VIX. And let's save this again. Here's the volatility of VIX. We talked about how abnormally bearish that was. It got down to minus 78%. It's still at minus 30%, so it's still got some room to go. Again, it's been typically bullish for the VIX, and it's been bearish for SPY when it's been this bullish, right? We tend to get these declines. Again, we see that same period before, the kind of what it looks like if we stay with this convergence pattern right now. We've seen a similar pattern to this before. Now, granted, the VIX, the difference between now and then, let's see, when was that exactly? That was on November the 10th, 2021. So the difference between now and then is on November the 10th of 2021, the VIX and the VVIX weren't so negatively correlated as we are now. So that's a big wrench that would suggest that both the VIX and the VVIX will start to ramp up coming out of expiration here. You also see it too in the ATR. The VIX is just unbelievably low. I mean, it's This is crazy, crazy low to get to, below this 8% mark. But, just at 7.96, again, for some context on how low this is, it's usually only this low when the VIX spikes. So the fact that it is this low already and the VIX hasn't spiked suggests that we may be headed, especially with that negative correlation, that we may be headed towards a VIX spike. I mean, this is pretty much the definition of VIX compression that typically leads to a VIX spike. And again, especially when it's combined with a negative correlation between the VVIX and the VIX. And a negative correlation between, or positive correlation between SPY and the VVIX too. So that throws this gap into question, right? So this is the thing that's really, really important for us. We have not filled in this gap from the 12th. And then the gap from the 10th is the one that we need to hold. But the Qs have filled in that gap from the 12th. We filled it in this morning, and it stopped at the 10th. Right, it's pretty much stopped at the top of the gap from the 10th. If you look at IWM, it also has filled in the gap from the 12th this morning, and it also stopped a little bit higher, but stopped at the gap on the 10th, and we finished filling in that gap too. So again, there's gaps to the upside on all three of these. Every single one has a gap to the downside, and we didn't finish very strong. So it's unlikely, and we did get close to 2%. It's unlikely that that's a runaway gap. It's possible, but it's unlikely. Remember, right here in April the 6th, so we had the March 29th. If I were to go back to March 29th here, let's go over here, and let's go out further. So if I were to go back to March 29th, so here's the March 29th, right? You can see we never really did get a breakaway, a runaway gap to the downside on SPY. You can see some gaps here. They all got filled in. This was the closest one, the 11th, that did not get filled in, and we ended up with a pretty down day. Eventually it did over here. But no significant, really the only one was on April the 5th, or May the 5th, was our only really runaway gap. So, that goes out to see what it looks like over here on May the 5th is right there. So we ended up being down more than 3%. So really, the closest that we would have had to is this April the 11th, and you can see another one there on April the 6th that was filled in just a little bit later here. But these two, that's about the same size of a gap to the downside, and we didn't finish that bearish. We were below 1%, but not below 2%. So it can be a runaway gap. It's unlikely, low odds, but it's pretty bearish, and especially on the Qs, right? It's pretty bearish, right? On April the 6th, that's what the Qs, we did finish below 2%, and we had a bigger gap to the downside. And then on April the 11th, we also gapped to the downside and finished 2%. So a very similar type of a gap now and a finish now that we had back then too. So just something to, that again, it's a good bullish pattern we have going into next week. And if it does bounce, very similar to last November, we can expect a period of convergence, slow grind to the upside, nothing too major, not like the last signal we just got a couple weeks ago. But there are some things that are just kind of like out there that increases the odds that next week we might continue what we saw today. And I would say it's still low probability, probably in that 30 to 40% odds range, especially with that negative correlation on the VVIX. So we'll expect that bullish bounce. I expect that bullish bounce, especially if we gap lower and we don't run away, we start to fill in that gap, then I expect that we'll fill in this morning's gap too. But if we gap up higher on Monday and we don't run it, like we don't get up and start to fill in that gap early in the morning, and we start the gap from this morning, if we don't keep going up, right? So coming back over here, if we gap up into this like 425 area, and then we don't keep going up, the gap holds and we reverse back to the downside anywhere in this area. If we gap up and reverse back down and start to fill in that gap, and this gap holds, and we get to lower lows, then then disregard that bullish signal in the market forecast, and I think that we have a good chance at being bearish here. If we gap down just a little bit and we start filling that in the morning, I'm going to feel really darn good about that bullish gap, that bullish signal on the market forecast. Again, for about another week, week and a half of just convergence type moves, just grinding to the upside. But that's okay, because that's enough to hold this gap here, this breakaway gap from August the 10th. That would be enough to say, okay, we've done it. We have changed the narrative. We broke out. We've held that breakout, and we're going to be able to keep going up through the end of the year, again, up to new highs. And again, we have to expect that, because the odds are that that's what's going to happen. There's a lot more corrections than bear markets. I still think there's a really decent possibility, decent enough to be relevant possibility, that we are starting a bear market now. But hence why I'm kind of hedged in our class portfolio. I've talked about a hedge. We've been doing bullish trades and doing bullish trades here. We'll do a bullish trade today. But I still have a hedge on because of that concern. If we can get through this week, get through Labor Day, so that get back to that green shading on the Ichimoku cloud and maintain position up here, then I don't need that hedge anymore, and I'm gonna full steam ahead towards the end of the year up to new highs. Again, like I said, Tom Lee and I will be singing Kumbaya, and everything will be great. Got to get through this week. Got to get through next week. What do you think? Which camp are you in? What are you thinking about this week? What are you thinking about this bearishness? What are you thinking about these indicators I just showed you, these signals I just showed you? Share with me down in the comment section below what stood out to you and what you're thinking about some of these things I showed you. All right, really quickly, I'm going to go through the rest of this video. That was a long discussion there on the technicals that we're seeing. I want to share with you kind of what's been driving a lot of this bearishness that you see here on the 3-month chart, with these equities being at their biggest levels. But let's look at just the last 3 days. So that would be 8/17 to 8/19, and you can see it's a high commodities, high dollar, and then you can see bonds in yellow down here. That would mean high yields. Remember, that's the story. That's the year-to-date story as well. High commodities, high dollar, and then bonds down here at the bottom, which means high yields. That's the inflation story, and that's the concern about whether the narrative has changed, because the last 3 days we're back to that narrative again. Just like that, we're back to that narrative again. So if we can reverse that narrative, coming out of options expiration, then we'll feel pretty good. But you can see how a strong dollar and strong commodities is really bearish for risk appetite in general. And looking at the dollar index, I mean, that's a strong move. The 8 and 17 are about to cross back above the 30-day moving average there. Looking at commodities, not quite as bullish, right? It's still below that 38% retracement, still below the 50-day moving average, but at least above the 17-day, right? And the MACD is still above its moving average. So you're still in divergent mode there. And then looking at the 10-year yield, it broke up today and it got above the 50-day moving average. It's in divergent mode. It's trying to get above that 23% retracement. We're already back up to almost 33%. So that if that pattern continues, as it looks like, this is a pretty good bounce pattern in all of them, then again, you would expect, risk appetite. I mean, the dollar's already back up to its mid-June. I mean, it's back past its mid-June peak. It's already almost back up to this peak. S&P is nowhere near those lows. So that but the ARK and Bitcoin are. So it kind of shows you where, that short covering, which has really pushed the S&P up further than other risk assets, and the Qs and IWM, how much, if that narrative shift doesn't hold, how much we might need to pull back to catch back down to where the other risk asset classes, like, again, Bitcoin, ARK investments, those types of stocks that are in those categories are still down. Remember we talked about from a sector rotation before, just how bullish utilities have been in the last, during this upswing. That kind of, again, goes to show that this isn't a full risk-on move when you have utilities doing as well. Well, there, again, energy is popping up, and then safe havens outperforming with XLC and XLY moving sharply down. You got financials and materials. Materials is disconnected from energy, which it goes to show. I mean, this is more economic growth expectations, and just like that, we're starting to pull back from, was it the June? I think it was the June 17th. Yeah, that's when we started to really rally here. I guess it would be June the 21st is when it. I guess we were bullish on the 17th. We started to pick up there. There's the utilities still doing very, very well, outpacing a lot of these other cyclical areas outside of XLK and XLY. Again, very short covering. Staples really doing pretty well too, keeping up with like XLC for the most part, and outpacing materials and energy, which again is a reflection of the safety trade is still very highly prevalent. Real estate as well, outpacing financials and industrials. Real estate, again, not necessarily the most risk on, and again more indicative of again a lot of short covering, and some of the more bear XLK and XLY were just so bearish coming into that June 16th low point. They were so bearish, and this rally that you see, so it looks like it was, and yeah, it's probably the 5th would be the day that it started. The decline started, yeah. So the 5th decline started. So you can see, how bearish they got down here into June, and then now going into today, all that big short covering rally got us up to these levels. Still down 15%, still down 20%. So I mean, that's how much they've had to run, and XLC has not participated, and other risk assets have not participated, and utilities is just killing it, and staples as well, and healthcare. I mean, just killing it, which is a sign that this bullishness was not nearly as bullish as we thought it was. All right, so if you look at our trade idea of the day, I want to take a look at Micron. So Micron's getting that same bullish signal. You got a bull tag here, right? You've got you're down to the 30-day moving average, but not too far below it. You've got light pink shading, which means that we're below 80th, but we're not down below 50 yet. So we've had a little bit of a pullback. That's a bullish signal. You got 3 red arrows on Micron. That's a bullish signal. It's one of those signals that we either bounce off of this, like we did last time we had 3 red arrows, or we keep breaking down, and we'll know really, really quickly if that's the case. You take a look at like its long-term crossover chart, you can see that we have been pretty bearish, and we're getting some transition candles here, and so again we either take off or move down to the downside. You can see from an Ichimoku cloud standpoint, we did not quite get above that cloud. We're still kind of in the cloud, and when you look at the DMI, we didn't really get strongly bullish either, right? We never broke out here on the positive. The negative's already back above 25, and the positive's dropping. So what I've done here is I said, okay, I've already got a trade from our class portfolio to take advantage of some, if things break down in chips and Micron included, then I've got a trade that will really pay out big. Like this was a really aggressive speculative trade, very low risk, very big reward, very low probability. So if we break down, then we're going to make more than enough money on that particular put vertical spread. So what I decided to do is say, okay, well, if we bounce up, then we won't need that anymore if that bullish signal plays out. And I wanted something that could pay off with a decent return to the upside. So what I decided to do was this bull call spread, going out to the 65, buying the 62.5, not quite buying out of the money, so it's a little bit more aggressive, but not nearly as aggressive as what we see on the other side, right? If I were to go here to the other trade, this is like, I mean, it would take more than a 1 standard deviation move, but less than 2, about 1.5, to be able to get down to the maximum gain. But for $500 of risk, I've already lost about half of, then I get a 5x reward. So right now it'd be 10x reward if I got out right now, which I would if we bounced up. If we bounced up, this plays out, then I lose a few $100, maybe $300 on that long put. but then I can more than make up for it with this bull call spread, making $1,000 for, you know, a few $100. And again, if we break down, then I'll lose a couple $100 here, which will be fine if I'm making $2,500. You know, if we ultimately keep going to the downside, which you expect that we would, right? We're either going to keep moving, we're going to either bounce off of this, or things have broken down, right, on Micron, and we'll, you know, we avoided it there, and we got that same 3 red arrow signal. The question is whether we'll avoid it again here with the big gap and the runaway gap here. And like, we filled in the gap there, we filled in the gap there, we filled in this gap here. So we've had, you know, 1, 2, 3 potential moves, now a 4th potential runaway gap. You know, is this going to be the one? So if it's not, we're got this bull call spread that we're doing right now. If it is, then I've got that long put vertical from our class portfolio that will pay off to the downside if it works out in that case. So that's our trade idea here for today. Again, trying to take advantage, just to review, trying to take advantage of the 3 red arrows, light pink shading, yellow line signal. So that bullish signal, it either turns into a bullish bounce, kind of like what we're seeing on the S&P, or we break down. So the trade today, since we already had a bearish trade, the trade today is to give us something if the bullish signal plays out, and if that bullish signal on the broader market plays out in conjunction with that. All right, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have there. Reply to anybody else's thread. And let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Have a great rest of your weekend, everybody. And we'll see you all on Monday.